Varun Goel, the Senior Fund Manager, Equity Mirror Asset Manager, is joining us on the show right now. Varun, hi, good to be speaking with you. Been a while. But what do you make of the market setup right now? Is it time to buy after the correction, especially in the broader markets, or do you anticipate more pain?
Yeah, good afternoon. Thank you so much for having me on the show. I think if you look at the markets, we have corrected roughly 10 to 15% from the top that we saw in the month of September. I think if you look at the time duration, also last year in January, February, markets were at similar levels. So we spent a year, trading sideways with a good 10-15% correction. If you look at FY26 valuations, I think if we look at 1200 rupees EPS for Nifty 50, we are trading at around 19 times, which is, let's say, 5-7% more expensive than what is the 10-year average. So I think we have already seen a significant correction. Can there be another 5-7% correction? It is possible, but very difficult to time. So I think it's a good time to start deploying your money, starting putting money to work. And I think in the first few months of this calendar, we are getting that opportunity to create a good medium to long term portfolio.
Right. Hi, Varun. This is Shrishti also joining in. So further correction can't be ruled out at this point in time. But where will you start deploying your money? Any sectors that are looking decently well placed and attractive to you at this price point?
Yeah, I think broadly, if we see the rupee depreciation is a big comforting factor for several exporters. Like IT, pharma, chemicals, clearly these three sectors will be big beneficiary of that, 3 to 4% depreciation that we've seen in the rupee. I think, if you look at IT as a space, we expect the US BFSI demand to be strong. The US economic outlook continues to be good from a growth perspective. I think if you look at the domestic pharma space, while we continue to see good growth in domestic formulations, the US export market again continues to be very interesting. I think both from a generic and contract research and manufacturing perspective. I think chemical sector again has been undergoing a downturn for almost 3 years, and we expect demand to start recovering. So I think broadly, as far as the exporters are concerned, we should be okay. I think banks, we have seen the worst in terms of earnings, and hopefully, post the easing of monetary policy, we expect a rate cut in February, and post which we expect things to start getting better as far as the whole lending financials are concerned. So I think these are some of the pockets which look interesting.
Okay, some of these pockets look interesting, but which are the areas that you would recommend to stay away from? Are those PSUs, Defense Railway Pack, any other name that you would recommend where people should look at booking profits now?
Well, I think there were pockets of froth in the market, whether it's select PSUs, railways, defense, some PLI manufacturing companies. I think broadly, I know we have seen 20, 30, 40% correction, some of those more expensive names. I think markets will, by the time we are done with this correction, we will see significant pockets of value emerge, which has already started to emerge. Our sense is, different sectors, different themes bottom out at different points of time. Like different sectors peaked also at different points of time in the last calendar year. So it's a good time to start identifying those right names and putting money to work.
All right, Varun, but when you talk about the consumption theme, we all sang the theme related to the urban and the consumption slowdown. But given the fact that budget is just around the corner and there are some hopes pinning in that consumption actually could lead the way and there can be some respite in terms of getting the money in the hands of the people, are you also constructive on the consumption theme?
Yeah, I think we saw a cyclical slowdown in the economy in the last few quarters. I think we have already seen the worst in terms of growth. We expect this quarter onwards to growth to start improving, and the next financial year FY26, our sense is the GDP growth will average somewhere between 6.5% and 7%. We had a fairly good monsoon, reservoir levels were good, and therefore we expect the Rabi crop output to be good. I think the Rabi crop will get harvested, will start getting harvested now between now and February, March, and the farmers should get money in their pocket by March, April, and that's the time we would expect the rural consumption to really pick up. If you look at most of the consumption stocks, we have seen a very sharp correction, in both in terms of time and price in the last 1 to 2 years, and we see value definitely emerging in some of those spaces.
Okay, what do you make of those beaten down sectors, the likes of cement, etc.? Because on one hand, the real estate demand was quite strong. There was that pricing power that was coming back. Consolidation was expected to be largely over. But if you still see the results, they continue to disappoint.
Yeah, I think what we've seen is a very muted price action for the cement space in the last I think 12 to 18 months. There is an expectation that we should see some price hikes going forward. It is very important that the producers are able to pass on the increase in cost. So one will have to wait and watch out for that. Also, please keep in mind that starting May, June, we will have the monsoons, and then 3 to 6 months the construction activity may again get tepid. So I think selectively one can look at the space considering the underperformance in the last 12 to 18 months.
I just wanted to follow up on that consumption theme that you were talking about. You did highlight a couple of factors that could be at play, but it's a very broad basket. So where should one start looking at? Be it staples, some of these auto companies like you were highlighting, the rabi crop, maybe tractors, or the discretionary spending trend is something that we can see continuing. What are your thoughts?
I think as far as the farm income related plays, definitely I think tractors and farm equipment clearly stands out. We expect the tractor cycle to start recovering. Already the last 1 quarter has been good, and we believe this thing should see further strength. Again, I think discretionary consumption, travel, tourism, hospitality still continues to be very strong. We've seen very strong results from the hotel companies. I think so that space will continue to do well. I think selectively stable companies, on the food side, should start seeing inflation getting under control, and we expect gradual recovery in demand. So those are some of the areas that we would want to focus on.
Okay, Varun, thanks so much for joining us today. I appreciate your view on the market and the way forward from here on. But time now to slip into a very short break. Don't go anywhere. Lots lined up when we come back.